Hi everyone, my name is Brandon Tan, and today I'll be presenting the case of Envoy Pty Ltd versus the Commissioner. Before I begin, I would like to outline the legislation in relation to this case. This case was judged based on Section 51 of the ITAA 1936, which is the old legislation. Section 51 was later on translated to Section 8 of the Income Tax Assessment Act 1997. Section 8 is divided into three parts. The first part is the first positive limb, which provides that any expenses incurred in gaining or producing your assessable income is in fact deductible. The second limb provides that any expenses that is necessary incurred in carrying on business for the purpose of gaining or producing an assessable income is deductible. The last one will be the exclusions. A deduction or loss is not deductible if it is a loss or outgoing of a capital, it is a loss or outgoing of a private domestic nature, it is incurred in relation to gaining or producing exempt income, or a provision of the Act prevents you from deducting it. Here is the flow of my presentation. First, I'll be talking about the introduction. Next, I'll be talking about the case and background, the issues, judgment and reasoning, implication for practitioners, and at the end I'll provide a reference list. Without further delay, let's get into it. This case had two hearings. The first hearing was heard by the Federal Court in year 2000. The second hearing was heard by the full Federal Court in year 2001, where the final decision was made. This case deals with the deductibility for income tax purpose of certain interest payment made by the taxpayer, specifically interest on loan borrowed for the renovation of property. Thus, the taxpayer tried to claim a deduction for the interest incurred in relation to the renovation of property, but was denied by the Commissioner. Thus, the taxpayer lodged an objection against the decision made by the Commissioner, claiming that the interest expense incurred in respect to renovation are in fact deductible under Section 8 of the Income Tax Assessment Act 1997, and was held successful. The Commissioner in this case argued otherwise. The debate has made its way to the attention of the full Federal Court, where the final decision was drawn. Let's now move on to the facts of the case. Peter Watzlawick, a businessman, purchased a property in July 1983 with the intention to restore the building to its original form. Mr. Peter Watzke had an idea of renovating the building, and as a result, he took a loan to do so. The loan borrowed had led to an incurred in interest expense as well as a borrowing cost. The Commissioner provided that the cost incurred on borrowings used to acquire the property is deductible while disallowing the interest paid as a deductible expense, claiming that the interest paid was in fact a capital gain. Mr. Peter Watzlawick in this case was not really pleased and had objected against the decision made by the Commissioner. The Administrative Appeal Tribunal at the beginning held that the property was purchased with the intention to resell it for profit later on, rather than it being used as a residence. However, the taxpayer had failed to demonstrate necessary evidence between the outgoings of the interest and further income-producing activity from the property. Not being satisfied with the decision held by the AAT, the taxpayer had exercised his right in appealing to the Federal Court, where the decision made by the High Court in Still's case was taken as a reference into determining the case. Let's quickly talk about what happened in Still's case. In Still's case, a taxpayer held the property for a period of time before developing the property. At all times, Mr. Still's intention was either to use the property to produce income or an assessable profit. The Commissioner challenged Mr. Still's ability to claim a deduction for interest incurred before the property was developed. The Commissioner was successful at the full Federal Court level, but was later on unsuccessful before the High Court. The High Court held that the first positive limb was satisfied, and thus the deduction prior to the property being developed was allowed. Based on Steele's case, the federal court ruled in favor of the taxpayer, claiming that expenses incurred satisfied the first lien, and the interest was in fact deductible. The commissioner in this case was not satisfied with the judgment made by the federal court and had made a further appeal to the full federal court. A number of facts were stated by the full federal court that eventually provided the commissioner a victory against the taxpayer. The main issue here is whether the interest paid in relation to the money borrowed to renovate the property falls under the criteria of being a deductible expenses under Section 8 of the Income Tax Assessment Act, or whether it's a capital gain. There are a few reasons that the primary judge held to provide the commissioner the victory against the taxpayer. That in fact, there's 5 grounds that are considered here. Ground 1. The taxpayer may have intended to use the property at some time in the future to derive assessable income. However, the incurring of the interest was merely to preserve the capital asset until it was used for an income-producing motive in the future. The primary judge provided that there was insufficient connection between the incurring of interest and deriving assessable income in this case. The primary judge also referenced the case of English versus FCT to make the decision. Ground 2, the primary judge stated that the findings under Steele's case was not applicable as the taxpayer did not in any time mention anything about deriving assessable income down to the time of the court hearing. An outgoing must be incurred in the course of producing assessable income to successfully satisfy this exception of the first lien. In this case, the taxpayer had failed to provide sufficient evidence that the interest was incurred during the course of producing assessable income. Ground 3. Facts provided that the High Court had made a mistake by not affirming that the connection between the expenditure and the production of assessable income. Ground 4. The expenditure for which a deduction is claimed may be as applicable as a source of future income, but such an expenditure does not become an outgoing incurred in generating or deriving future assessable income merely because the taxpayer intends to use the property sometime in the future to generate assessable income. Ground 5. The expenditure was not deductible under Section 8 of the Income Tax Assessment Act because it would be deductible against the gross proceeds if and when the property was put to profitable resale. Another meaning for that is that it is saying that the interest should be included as part of the cost base to be deducted in capital gains tax when the property was to be sold next time. Well, after considering all the grounds stated above, it is therefore fatal for the taxpayer to claim the deduction as he has failed to demonstrate sufficient or any connection for the purpose of Section 8 under the Income Tax Assessment Act 1997 between the future income-producing activity from the property and the outgoings of interest. Well, before we conclude, here are some implications for practitioners. First of all, the difference between deductible expenses against assessable income and an item to be included in the cost base of a capital gains tax must be clearly differentiated. Second, the two positive liens must be satisfied. Third, relevant intention to whether a certain item or property being purchased for business or private use must be clearly stated at the beginning to avoid any confusion. Fourth, a connection between the outgoings and income needs to be established by a taxpayer to claim a deduction. The last one, Interest expense incurred in relation to improve an asset can only be deductible if the purpose of acquiring the asset to produce accessible income is to produce accessible income, or else it will be considered as a capital gains tax. Now, to wrap this up, a clear understanding of the difference between what is deductible income and what is a capital gains tax, together with the criteria it satisfies under the positive limbs, prevents practitioners from repeating the same mistake that occurred in Anoy's case, and most importantly, to avoid any future. Here are the list of references that I used to support my case. If there's any further questions in regards to my case, I am happy to answer all of them. Thank you for your time, and I hope you have a lovely day.